Hey everyone, welcome back for another episode of the Remote Real Estate Investor. My name is Emil Shore, and today I'm joined by my co-host
Tom Schneider.
And Michael Albom.
And on this episode, we're going to be diving into refinances. Is it too late as rates are going up, or should you do it now, or what are we all doing? So let's hop into this episode.
What are we doing with our lives?
Hey guys. Hey Tom, welcome back.
Yeah. Yes. What's up, Emil? What's up, Michael?
How you doing?
Excellent. I quick personal note. I was been working in my garage waiting to build this little lot of land, and I started getting lightheaded, and I realized that there is some just kind of like toxic fumes in my garage. So back in the house. So apologies if you hear some baby noises while we're waiting to build out the exterior office. That's my I'm doing good, man. Doing not lightheaded anymore. So
And the baby is not in the
inside,
garage,
not in
right?
the toxic hazard area. Yeah, we switched. Baby's I mean, it's got young lungs. Like they heal quickly. They obviously kidding. But,
Did you have the gas company come out and like report on what's going on?
I did. They're gonna have to come back again. So they came out. I mean, there's like two like gas entry points into the house. There is like a little further away the house, like a little gear thing you tighten, and then next to the house there's the meter. They replaced all the meter stuff, and I think it helped, but there's still some issues. So, anyways, don't want to go too deep into that rabbit hole. Yeah.
Never a dull moment with Tom Schneider.
All right. Well, I'm glad you are alive. Your brain cells are hopefully intact for this episode. And yeah, let's get rolling. All right. So we're recording this. It is April 11th. Interest rates have been climbing pretty quickly. I think I'm hearing 4.5%, 5% plus when we were in like, I got a 2.8 on my primary back in November. So 4 or 5 months, pretty crazy how quickly rates have gone up. And Michael, I think you have something pretty interesting going on. You were in the middle of a refi currently, and I'm not going to put words in your mouth. Go ahead. Tell us what's going on.
So not even in the middle of a refi, I was at the end of it. I was supposed to close today, and the lender calls me. He goes, "Hey, Michael, we're not going to be able to do this loan." I'm like, "What do you mean we're not going to be able to do this loan?" He goes, "Yeah, at the rate that we locked you at, we're not going to be able to do it." And so basically, just to give everyone a little bit of context, I started this investigation like 3 months ago into getting 30-year fixed mortgages for multifamily commercial property, so 5 units and up. And I found a lender that would do it. And I was making them compete against other lenders. I had a bunch of different quotes, and I found one, and they were like, "We can beat it. We can do it. 4.275 for a 30-year fixed on a commercial multifamily loan directly to my LLC. Low docs. They just needed my property specific information, how the property performs, like a DSCR loan." So we're getting all the paperwork done. I paid for the appraisals, several $1,000s for each property, and then my loan processor like just stops returning my phone calls and emails. I was like, that's weird. And we're getting up to the point of closing. So I got a hold of, I called his line, and somebody else answered. And I said, "Hey, I'm trying to reach this person." They said, "Oh, they're no longer with the company, but this other person is handling all of your stuff now." And I said, "Okay, I mean, that happens, turnover happens." And this new person who's handling my files sends me this email. She's like, "Hey, I need all these things from you." I'm like, "I already sent those to your company months ago. The original person had them. Like, do you not have access to my file?" And we went back and forth and back and forth. And I got them all these docs. And then they go, "Oh, we're going to have to close on Monday. Otherwise, your rate will expire." And I said, "Okay, great. I'm ready. Let's do it." And today, Monday, he calls me and says, "Hey, we can't do this loan." And what I'm pretty sure happened is they just realized that I got too good of a deal, and they can lend that money elsewhere and get a higher interest rate for it. And I still have not heard back from them as to why. I haven't gotten a direct, specific answer. But as soon as I do, I'm going to be naming and shaming these people all over the place, because I posted about it on Twitter and seeing if there's any kind of recourse. And people are like, "Yeah, I've been hearing of this happening more and more, of lenders just dealing with bad PR rather than taking the loss on their to their pocketbook."
I mean, what does a rate lock mean if that doesn't allow you to like lock your rate? Right?
That's a great question. And so what a lot of people online have been saying is that, oh, if the rate lock expires, then the rate lock is no longer valid, and which I totally get. But the question that still I'm having is, well, what if the lender is just dragging their feet intentionally to drag out the rate lock to expire so that they can say, oh, rate lock expired, sorry. And so they said, well, we can requote you at today's rate. And I said, great, do that. And they said, oh, it's at 6.25. I'm like, so 2% greater than what I locked it in at. And I did this all 3 months ago because I knew that rate hikes were coming. Everyone was talking about it. And I said, great, let me just lock this in, set it and forget it and be done with it. So it's pretty infuriating. So everyone stay tuned. I'll keep you all posted how it shakes out. But I have yet to get a call back from these folks explaining themselves.
I wonder if this is like a, you said it's a commercial loan product. It's a portfolio loan, right? Like it's a loan they're doing themselves. It's not like government backed or anything.
Correct.
I wonder if there's like different rules, if you're going to get your traditional conventional 30-year fixed rate, Fannie Freddie, like, would that have gone through versus like a portfolio loan? Like you said, they're like, why would we put this money out there for 2% less than we can get it today, or 200 basis points, not 2%, but you know what I mean?
Yeah. No, I got you. Yeah. I don't know. And that's one of the questions that I have out to the Twitterverse is, hey, what kind of rules and regulations are these companies governed and bound by? And how do we hold them accountable? Because I think for the government backed stuff, it is a little bit more clear cut. I would expect this less to happen in that space, but it seems like the commercial world, the private lending world is just a bit more unregulated. And so I'm wondering if that just might be the cost of doing business because of that lack of regulation.
Like you're done with, like, their lifetime value of you of a customer is gone. I don't know. Like I think that like could be kind of short-sighted. There's funny, these different vendors where there's like perverse incentives, like for this example, like them just kind of like waiting out the clock because they see the interest rates going up. And
Right.
There's a couple other scenarios where vendors that you rely on could have like bad incentives, like for
Totally.
like property managers that get paid on work orders. If they're making more money on work orders, they're going to be loved to be performing work orders. So I guess this, speaks to that whole like trust and having a good partner that you're working with. But man, Michael, that's a bummer. Like what a huge jump.
Oh my God. It's so incredibly frustrating. Like I had so many big plans for this money too. So it's just been a bit of a whirlwind of a day. But in speaking to like the question and the topic for today, I don't want this whole episode to be a woe is me session, my therapy session. You guys can bill me later. I hope you take insurance. But I think it's really important for everyone looking at their portfolios now or looking at their properties now to determine and kind of ask themselves the same question of, hey, does it make sense to refinance right now? And for me, it made total sense when I locked it in 3 months ago. I was paying a little bit higher interest than the current mortgage that I had on the property, but it was going to be a longer amortization period at 30 years over the 25 years that I currently had on the product. And then it was going to be fixed also for 30 years. So I wasn't going to have to go refinance in 5 years or 10 years like I will with the current properties, with the current mortgages that I have on these properties. And one of them is coming due, I think, next year or in 2024. And so I said, you know what, I can lock in the rate for 30 years. I know what it's going to be. There might be times when my rate's a little bit higher than what the current market is, but my guess is that for the most part, it's going to be less than the average interest rate that we find ourselves in over the course of the next 30 years. So let me just lock it in and I'm sure I'll be stoked. Today at 6%, 6.25%, I can't say that with as much confidence. And so for everyone out there listening, if your rate is less than what you're going to be refining into, think long and hard about giving that up. But also, if you're going to be taking, there's two ways to refi, right? There's the cash out refi, and then there's just a rate and term refi. For your rate and term refi, if you're going to refi into a higher interest rate, now might not be a great time to do it. But what are your guys' thoughts about like the cash out piece of this?
Look, if you bought a long time ago, maybe you've put some money into the property, you fix it up, your cash flow is nicer, and you're sitting on an opportunity to pull some cash out and still cash flow, that's something you should still consider. I don't think it's like, okay, rates have jumped 2%. Now it's a definite no. It's like we always talk about. You got to run the numbers, see if you're still cash flowing, right? Don't make it negative cash flow. In my eyes, and yeah, make that call for yourself.
I would say, obviously if you have like tons of equity and like you have a plan on what to do with that equity, if you were to convert it into a cash out finance, that makes sense. I think in some markets with interest rates going up, you would expect a little bit of a reflection in pricing to go down potentially. I don't know. It's hard to say because there is a good amount of demand. I would say it's more likely to be in like secondary and tertiary markets where you have a property with a lot of equity, cash out refi, get that in your back pocket. There could be some opportunistic acquisition opportunities with interest rates going up. I would say with like primary cities, like really big ones, Dallas and whatnot, since a lot of the maybe institutional investors out there are not going to be, have too much moving within their debt structures. But I'd say in some of the secondary and tertiary markets, there could be a bigger impact on rates going up and potentially prices going down. Like, I don't know, you would assume that, right? I don't know. That's my 10 cents. Michael, Emil, any thoughts on that take?
I mean, I think that makes sense, but I'm wondering too if we can kind of try to think like 2 steps ahead. And is there an instance or a scenario where it makes sense to take out cash via a cash out refi because you know what the rate is today and you have equity in the property, knowing full well that you don't have a plan for it in the immediate future, but you are opportunistic, you foresee an opportunistic environment. And so you're just going to kind of sit on it and see what happens versus doing nothing. And then you might see that equity actually evaporate from the property.
It's a good point, right? If rates are going up, right? I just, before we hit record, I just threw my loan into a calculator, right? Our primary, looking at that 200 basis points difference, and it's huge. Like, I don't know if we would have bought it. Like, it's over $1,000 difference, on the type of mortgage we have. So it's like, that's big. So, you can't have rates keep going up, payments keep going up, and like we have the same kind of crazy appreciation. I don't think. I'm not looking into a crystal ball, but yeah. So that is a good point, right? If you think, okay, rates are going to go up, rates are going up, it's going to keep putting pressure and like prices need to come down, then yeah, that could be a great time to cash out refi, hold some cash, and then buy when there's a little bit more opportunity down the road.
Yeah, and it's not something that I've thought about in the past. I've always kind of said, especially as in coaching with folks in the Restock Academy, is like, yeah, cash out refis are great if you have a plan for that money in the next 6, 12, 9 months. Or even just know what the money is going to be used for versus getting a HELOC could be a better use of funds and time if you're not sure what you're going to be using the money for. But now with rates going up so fast, I think I'm changing my tune a little bit and saying, yeah, maybe, even the fact, like we were joking about, Emil, in the last episode, that having your money in the bank, it loses 7% in value every year. Maybe that 7% hit is more valuable than, or excuse me, is less impactful than the future opportunity down the road. Because if prices drop 10 or 15%, I'll pay that 7% to have money sitting in the bank all day long to be able to jump on something for 10 to 15% discount. So I think you're right. It is super tough to know what to do. But I'm of the opinion that if you can lock in something today and you know what the payment is for the life of the loan or for the next foreseeable future, that has a significant value to it. And having cash in hand, we know what the value is today, and we don't know where rates are going to go. And so if it turns out that rates go down in a year from now, okay, well, you do a rate and term refi and take advantage of lower rates then, get your cash out now, and arm yourself. I don't know. I think that makes sense for a lot of people.
So I've got a little question for you guys. I'd love your guys' feedback. So with my primary refied, maybe a year ago, also took out a HELOC, used that HELOC to improve the value of my house. Now,
but not the gas line, apparently.
No, the gas line is fine. It's honest. It's more like it's a garage and it's moldy. Like, don't worry. Yeah, don't worry, PG&E. Things are okay.
Gas lines are not value add, by the way.
No, I meant to say this in the beginning. They do it for free. They have a number you call. They send a person out there just because like massive liability if there is issues with the gas line. But my question for you guys is: so I have a HELOC on the primary, did some improvements. And my strategy was originally just to refinance again and then put that HELOC debt into the primary. But with rates going up right now, does that make sense? Like I, have a good size amount of cash on that HELOC or debt on the HELOC. Do I just eat it and roll that into a refi? Or because, assuming rates continue to go up, like that HELOC payment is going to become more and more.
Yeah. How have you seen your HELOC interest rate creep up in the last couple of months in lockstep with like traditional mortgage rates?
I assume it would be sensitive to it, just in that HELOC, is not fixed debt and that it's moving. I haven't looked at it in a minute, but that was always part of the plan, was to roll that in.
Do you know how big of a difference your interest rate would be from your current primary mortgage to what your new one would be?
It's a very good question. These are all good action items to go out. And go get.
Tom always finds a way to get just personal advice.
I know. Self-serving all the time.
Free coaching on
that's it
on the podcast.
No, I applaud you, man. You're smarter than the average bear. I think that what would be is one thing I would want to know is what's the new rate?
HELOC interest rate right now is 2.49, so not going to do better than that. But
and that hasn't moved in the last couple months.
Hasn't moved in the last couple months, no.
Yeah, so I would. Tom, you turned me on to that lender, and I actually got a HELOC from them too, and it's amazing.
Yeah.
I would try to go get some clarity around if you did roll this all in, what would be your new primary interest rate?
I like it.
Because you got to remember, even if the rate blows up on the HELOC, call it 5, 6, 7%, it's interest only versus the fully amortized principal and interest payment you'd be making on that additional debt. And so I would look to figure out, okay, where's my break even point? At what rate can I afford to pay fully amortized principal and interest versus just interest only? Because interest only, it's going to fluctuate up and down versus the P&I, that's for the life of the loan.
Locked in. Yep, that makes sense, Michael. It's good feedback. Self-serving.
Yeah. And then, just on top of that too, also think about the cost of doing that refinance. There's several $1,000s associated with it. And so if that's what you have to eat in terms of your additional interest payments on the HELOC, but you still have a better rate than you would, that in my mind means, pay the extra interest. Just eat it.
Michael, I should have asked you this before we left the conversation of your refi changing.
My name and shame.
Are you going to go through with it? Are you going to go through with it?
No,
that's the big question, right?
No way. I'm not. Because here's one of the problems is like right now I'm at 3.25% interest on 10-year fixed with a 25-year amortization. And I'm like three years into those loans. So they have a long life cycle still left. I would much rather be on 30-year fixed. And at 4.25%, I'm happy to pay the additional percentage point on interest just for that fixed and additional cash out. So the thing of it is, it's almost like, and the payment on that was going to be a little bit bigger than my current one, even though the interest rate is higher, but I was getting a ton of cash, but it's over a longer amortization. So it all kind of smoothed itself out in the end. So I was essentially getting some free money. So yeah, it's just infuriating beyond belief. So yeah, stay tuned. I'll keep you all posted how it shakes out.
Got it. Yeah, I just wanted to, I don't think we closed the loop on that. I wanted to know, are you still moving forward?
No, these people will be getting zero of my dollars ever. And I will encourage everyone I know or ever will know to not use these people if they don't make it right.
But okay, let's say you go get the same 6.25 or whatever from some other lender who is not a monster and screws you over like that. Would you do that?
No. The rate at that level just doesn't make sense from a cash flow perspective. And that's why I was so excited about this loan was I locked it in when it totally made sense.
So not just a spite decision. It's
it's a financial one. Like it just
financial decision.
It doesn't make sense. Right. It doesn't make sense. So, and that's something that people really need to be thinking about is kind of like we were mentioning, Tom, with your loan is the cost of the loan. If you're going to go do a refinance, there's money involved to physically do that. Some lenders will wrap the closing costs in. So you pay it, you pay it up front, but you pay it over the life of the loan. And so just be factoring all this stuff in and also be factoring in like, what could you do with the proceeds if you are doing a cash out refi? What kind of return could you get on that money if you went and spent it elsewhere? Because that can often make the interest rate a little bit easier to swallow if it is high. Yeah, you might be paying 6%, but you can go make 8, 9, 10% on that money somewhere else. I think it's important too to find out and take it from me. what the track record is of your lender if you are going to be refining. Research them online, do your homework, find out if they can actually close the loan, because anyone can say anything, but until they fund that loan and it closes, it's all just hearsay apparently. I am so bitter. God, it's coming out terribly.
Yeah. It would probably be hard to vet this one because, like, you know, we've been in a really low rate environment for years. So no one else has probably experienced this. I'm sure there's other people who are trying to get a loan from them who are now going through it just like you, but you probably wouldn't have found any of those online because, you know, rates have been low for a long time and everyone was just scooping up refis.
Right.
No problem.
And they had, you know, they had good reviews online. So I did do my homework. It's just a weird time in the market.
Yeah. It's just interesting to know that a rate lock, at least with, like, I don't know, maybe just portfolio lenders, it basically means
meaningless.
Nothing.
It's meaningless unless they decide it means something.
It's rust proofing on your offer.
That's crazy.
Yeah.
Well, maybe that's the takeaway for our listeners is, like, if you're going out buying, refining, whatever, find out about your rate lock. Like, you know, see if it really is like for 30 days or however long you are 100% guaranteed that rate, or can the lender opt out of it, or how does it work? So good question to ask your lender.
Mm-hmm. Yeah. Tell them you heard a horror story on this podcast you just started listening to and say, I don't want this to happen to me.
And with that, we bid you all farewell. Fair due.
A fortnight fair due.
Adieu, farewell. All right. So I guess that's probably a good place for us to end this episode. Thank you guys. As always, Michael, thanks for giving us a little deep dive into your paper cut flesh wound.
Oh, dude, this feels like a full
Steaming.
digit got sawed off. This isn't just a paper cut. I lost the whole thing.
Hopefully the story ends up well for you. But all right, everyone, we will catch you out on the next episode. Happy investing.
Happy investing.